Welcome to the Deep Dive. We're your shortcut, really, helping you get truly informed by digging into your sources and pulling out the key stuff. Today, we're tackling something absolutely crucial if you're looking at the market seriously, the risk-reward ratio. Because, so many people dive in just thinking about the big wins, right? And that often leads down a path of, emotional trading, basically gambling. But what if there's a sort of mathematical foundation, something that separates real calculated speculation from just hoping for the best? Well, if the actual key to doing well long-term isn't about being right all the time, but really understanding the stakes, what you could lose versus what you could gain every single time you make a trade.
Yeah, it's funny how fundamental it is, yet often kind of glossed over. The risk-reward ratio, or RRR. It's not really for looking back at how your whole portfolio did last month. It's very much a forward-looking thing, a planning tool you use before you even get into an individual trade. It basically just quantifies your potential upside for every dollar you decide to put at risk. You usually hear it risk-reward, say 1.2. That just means you're risking $1, aiming to potentially make 2. It's all about setting up the trade structure beforehand.
Okay, so if it's about planning before the trade, how do you actually do that? What are the practical steps to set up that structure?
Right. Good question. So before you even think about buying or selling, you need to pinpoint 3 specific prices objectively. First, your entry price, where you plan to actually get in. Second, your stop loss price. That's your escape hatch, your predefined maximum loss if things go wrong. And third, your take profit price, which is your target where you plan to get out with a gain. And crucially, the risk part here, it isn't the total money in the trade. No, it's just the difference between where you get in and where your stop loss is set. That specific planned potential loss.
Okay. And that deliberate planning, focusing on the potential loss first, that's what the pros call the risk-first approach, isn't it? Which feels, I guess, a bit backwards for newcomers who are naturally drawn to the potential profits.
Absolutely. It's a huge mindset shift. Mark Minervini, the legendary trader, he nails it. He says, with every trade I make, my approach is always risk first. It's all about protecting your capital. That comes first, always. You have to control what you might lose before you even dream about the gains. Because, if you don't manage those losses, you just won't be in the game for long, right? Your capital disappears. It's the difference between playing to win, maybe recklessly, and playing smart so you don't lose everything.
Okay, let's dig into the power of that. So people often obsess about their win rate, how often they pick correctly. But if you're disciplined with, say, that 1.2 RRR we mentioned, how often do you actually need to win just to, not lose money?
This is where it really clicks for many people and kind of flips conventional wisdom. With a consistent 1.2 risk-reward ratio, you only need to win. Get this. 33.3% of your trades to break even.
Wow, only a third.
Yeah, just a third. Think about that. You can literally be wrong twice as often as you're right, and you're still basically flat. So imagine a trader, right? Maybe they only win 40% of the time, but they consistently aim for a 1.3 RRR. They could actually be way more profitable than someone else who wins, say, 70% of their trades, but has a really poor RR, maybe 1 to 0.5, where they risk $1 to make 50 cents. It just shows that the structure of your wins and losses, how big they are relative to each other, which RR helps control, is often much more important than just how often you win.
That's a massive shift in perspective. But wow, it sounds like it needs serious discipline. What's the biggest sort of internal battle traders face trying to stick to this, especially when a trade starts going against them?
Oh, it's almost always psychological. It really is.
Right.
We humans were wired with biases. There's loss aversion, for instance. Psychologists find that the pain of losing, say, $100 feels roughly twice as bad as the pleasure of gaining $100. It's irrational, but powerful. And Minervini talks about another one, the fear of being wrong twice.
Being wrong twice. How does that work?
Well, you're in a losing trade, right? Your stop loss level is approaching. The fears isn't just admitting you were wrong on the trade. It's the fear that you'll take the loss, be wrong once, and then the price will immediately reverse and go where you originally thought, making you feel wrong again for getting out. So you hesitate, you hold on.
I see. That double whammy fear.
Yeah.
So how do the professionals push past that? How do they make cutting losses, mechanical, like a cost of doing business?
Mostly through rigorous discipline enforced by technology. Using preset stop-loss orders is key. Once you've done your analysis and decided on your entry, your stop, your target, you place those orders, especially the stop-loss. Having it preset in the system takes the emotion out of the decision when the price actually hits that level. The exit just happens. It helps reframe that loss. It's not a personal failure. It's just an anticipated operational expense like any business has.
Right. It makes it objective.
Yeah.
So 1.2 sounds like a really strong foundation.
Yeah.
But is it like a hard and fast rule?
Yeah.
Or does it need adjusting sometimes?
Good point. No, it's not dogma. While 1.2 is a fantastic starting point and very common for swing traders, it's definitely adaptable. You might adjust it based on your trading style. Maybe scalpers aim for smaller ratios more often, or position traders look for much larger ones. Market conditions matter too, like volatility, and the actual chart pattern, the objective market structure, should guide your stop and target placement. The ultimate goal isn't hitting a specific ratio every single time, but ensuring your trading system has a positive expectancy overall. Meaning, over many trades, your average winning trade is larger than your average losing trade, enough to overcome the win rate. RRR is just central to making that math work in your favor.
It really seems like the path to becoming a more professional trader involves this fundamental mental shift. It's moving away from constantly asking, how much money can I make on this trade? And instead, making the primary essential question, okay, if I'm wrong on this idea, how little can I possibly lose? That's a powerful thought to leave you with. Thinking about loss first, it changes everything.